Hello, hello. Good evening, everybody. Callie,
good evening.
How are you?
What's up? What's up? It's great to be here.
Compound Nation. Josh is in Las Vegas, so we've got a better replacement, joined by the Chief Market Strategist at Ritholtz Wealth Management, the one, the only, the brilliant Callie Cox. Welcome, welcome, welcome.
Hey. Oh, you're too kind, Michael. Happy early Halloween, I guess.
Happy early Halloween. It's almost election week. Bitcoin is Bitcoining.
Got to talk about that.
The stock market is doing its thing, hanging high.
Stock market isn't doing much.
It's weird. It's
Yeah.
weird. All right, we're going to get into all of that. What's going on in the market? Why is it so quiet, given that there is potential, not disruption coming, but there's an election. And usually the market is doing more than it's doing today. So, okay, before we get into it, I'm sorry that I'm not in the chat, but you have my full attention, okay? I will not be encumbered by what's going on. No distractions. I'm locked in. So, Giancarlo and everybody else who's hopefully in attendance, thank you as always for tuning in. We love that you're with us in the live. It's 5 o'clock on the East Coast time. You could be doing anything, but you're with us. So, thank you for hanging with us. All right, we have a sponsor tonight, and it is Public. The good folks at Public they've got your back. Peak yields, money market funds, all the cash, the peak yields are behind us. So we've got to do something with the cash. We've got to get it out of cash because rates are going down. Weirdly, bond yields are going up. So at Public, they've built a really easy user interface. You could select individual bonds, and we're talking investment grade, none of this junk stuff. What we know, Apple, Microsoft, etc., whatever you want. Click, clickety-clack, click, click. That's actually what happens. You get up a bond portfolio, you get 6% or whatever it's yielding right now. So go to public.com/what are your thoughts to learn more. And I've got to read this to you. So here we go. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across a bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. That's risk. Visit public.com/disclosure/bond-account for more info. All right, Callie. Let's get it on. Before we get into the first topic, the election and investing, we had some earnings this afternoon, some big earnings, in fact. And let's throw this up, John, if you don't mind, from StockTwit. So they've got you covered on the updates. AMD, and I don't know if this is data or not, but this is just the initial reaction. So AMD, not great. I saw they lowered their guidance, down 6% or so. Google's popping. Snap was down 13, then up 12, and I don't know where it is right now. Chipotle, not great. Visa, neither here nor there. Reddit up 20% or so. Let's just do Google really quick, a stock that I bought last month. That's a lot of green. A lot of green on the screen. You had revenues up 15% year over year. You had earnings up 37% year over year. YouTube up 12% year over year. Look at that. Alex Morris. Yeah, next chart. There we go. Alex Morris says YouTube trailing 12-month ad revenues are $35 billion, up 130% since year-end fiscal 2019. YouTube ads and subscription trailing 12-month revenue surpassed $50 billion for the first time. That's wild. $15 billion in subscriptions.
YouTube is a cash cow. Are we shocked? I mean, Joe Rogan's on there.
I'm not
should not be shocked.
But there's just been a lot of noise and chatter about how AI is coming, how people don't even use Google search anymore. They're using the AI competitors, OpenAI and whatnot, and maybe it'll be a killer, but not today.
No. And this is something that I don't think people realize about big tech companies. The story is all around AI and markets, as it should be, Michael, because markets are forward looking. They're thinking about what's ahead. But when you look at revenue and earnings for these big tech companies, outside of NVIDIA, because NVIDIA is a separate case, but a lot of these big tech companies are still making money off of these more traditional products. I mean, for Google, it's, like you said, it's ads. For Apple, it's services. AI isn't really a money generator yet.
And cloud revenue, where is this? Was it 11 billion, up 35% year over year, just insane numbers. And I think the first thing to go, if we are entering a downturn, and of course the economy's not in a recession right now. But if it were, you would see a slowdown in ad spend, and that would hit Google, of course. That would hit Meta, of course. I don't know if Snap is like its own beast, but Snap is doing well in the after hours. At least it was. So we've got a busy week of earnings. I believe Microsoft is tomorrow, and of course we've got the rest of the Mag 7. We already heard from Tesla, but and Netflix. We've got Apple coming up, and Nvidia is in a few weeks. So we shall see. All right. On to the first topic, which is we do have an election coming up. And I think that, Callie, we probably take for granted the fact that the market moves on many things. And sometimes it moves on elections and politics. Like sometimes it does. But by and large, the message that we send to our clients and hopefully the people that are tuning in is that relax and zoom out. And so Callie put together this chart book with the help of Chart Kid, Chart Goat, Matt Sermonaro, and Sean Russo over here. So, all right, chart on. Presidents, of course, don't control markets. For people that are listening and not tuning in, what we're looking at is the annual return during presidential terms, and we're looking at the max drawdown within each term. And the blue is the Democrats, and the red is Republicans, and up, down, up, down. But the point that I want to make is that markets are always volatile. We have a drawdown regardless of who's in the office. Callie, you are the creator of this chart. What is that the message here, or is there anything else?
Yeah, I mean, I think that's exactly right. The other thing that I'll say is we didn't highlight recessions on here. We didn't highlight profit growth. And honestly, that's what you should point out on a chart like this. Because the common thread in the stock market is the economy and earnings. It's not who's in the Oval Office. I mean, I've said this a lot over the past month or so, and I think I stole this from Ben, honestly, but it's a great saying. The U.S. stock market is $57 trillion in size. Huge. To think that one person can control the entire $57 trillion stock market is insane. And honestly, if I were to pick a person, it wouldn't be the president. Might be Jay Powell, might be Jensen Huang. But I mean, what you're going to get these days is a lot of stay invested, don't pay attention to it. And while I completely agree, I think that there are a few asterisks that you can draw there, right? Like, don't buy or sell based on the president, but understand that elections often lead to some kind of policy change, especially if if the changes in Congress make it a little more unified versus divided. So honestly, Michael, I get a little annoyed. I'm like, the takeaway is stay invested, and like you can pull data from history that just shows that over and over again. But it's like, yes, but give us more context than that. And that's exactly why we created the chart book.
Yeah, ignore the noise is horrific advice, because come on, we're in the noise. We live in the noisiest of times, so you can't ignore the noise. But it doesn't. I don't care who you're voting for. But as far as your portfolio goes, just keep your eye on the ball, eye on the long term. Next chart, again, just to the point that we're making, is up and to the right. And of course, there's dips, and the president is not the thing. However, even though the president cannot control the market, certainly there are chart off, please. There are policies that matter, and the market seems to be discounting it, at least with respect to the potential for President Trump to come in and do what he's telegraphed as far as his policy with tariffs. So John authors via Carl Quintanilla, Trump's declared policy is to hike tariffs far more aggressively, and the market is wise to this. So the chart that we're looking at shows how branded retailers who stand to suffer the biggest potential tariff impact have performed relative to the average stock. And this is not great. The tariffs would not be good for these companies, and so relative performance has been bad. So, like, yeah, it's not that the president doesn't matter at all. Like that, I don't think anybody's saying that. It's that there are larger forces at play: inflation, the labor market, earnings. Like all of these things are much more important over the long term than who wins next Tuesday.
Exactly. Yeah. If you're a long-term investor, which I suspect many of you are, you should, like Michael said, keep your eye on the ball, and the ball is the economy and earnings. This is what I like to say to clients. I basically just say, yes, it's a noisy environment. Your bar for information should be low. And look, if you're watching, what are your thoughts right now? Your bar for information is low. You're taking in a lot, but your bar for decision-making should be high. So take it in, but don't let the majority of that affect your decision-making. Have the right filter on,
Look at this next chart from Y Charts. This is showing the DJT, which I guess, I don't know, is this a proxy for Trump's odds of getting elected? Is this a proxy for what people think Trump's odds are getting elected? Is this complete noise? Like, do you have any read on this? Because clearly, Well, not clearly. I mean, for people that are listening, this stock has gone from, I don't know, 15 a couple of weeks ago up to 52 today. So better than a triple and a half in a couple of weeks. I mean, my interpretation of this would be that the market is, at least this stock is optimistic that Trump is gonna win.
Yeah, I'm getting meme stock vibes. I'll be honest.
Yeah.
I agree with you, Michael. But I think if you line this up against like poly market odds, it probably aligns pretty well.
It's so hard to unpack what's really happening with the betting markets and the stocks, and how much of it just feeds on itself and momentum. Like we don't know, right?
Yeah.
Like we'll find out in a week. All right, this is sort of interesting. ChartKit has a chart of the average VIX level in election years versus the VIX in 2024. So what you see, at least my takeaway, is that in previous election years, the VIX had been pretty much elevated all year in the 20 or so range, and we had a low VIX until the spike in the summer, and it actually has been rising. So it's not it's sort of, by no means is this like one for one, but it is rising, which is weird. That, and I know, Callie, you're an expert on this. It's weird that the VIX is rising even though volatility is not showing itself inside the stock market anyway.
Yeah, Michael, you're going to be really sad that you said that, because I am probably the biggest VIX nerd of all time. And Michael knows this, by the way. But yeah, it is really interesting. I mean, if you don't know what we're talking about, the VIX is obviously a gauge of S&P 500 options prices. So when fear goes up, theoretically people trade options a little bit more. They buy puts on their portfolios. That causes the VIX to move up. It's just supply and demand. So when stocks are moving higher and the VIX is moving higher, that's weird. Like VIX, the VIX and the S&P 500 move in reverse of each other about 75% of the time since the VIX started.
But right now they are both moving higher together, right?
Yeah, they are. So if you look at it over the last month, yes, they've both moved higher together. And a lot of people are saying like, what's around the corner? Throw in Halloween analogy. I just think it's the election. There are a lot of institutions buying longer or month dated S&P options around election day. And you have to know how the VIX works to really understand this. I mean, the VIX takes in option premiums, or it kind of calculates option premiums for options that expire 23 to 37 days out. So yeah, a few weeks ago, we did see the VIX rise up to 20. And I think the S&P hit record highs that day, and everybody was like, ooh, ominous, what's going to happen? But that was also one of the first days when that 23 to 37 day range was picking up election day and the days after election day. So it's a little technical, and I probably wouldn't look too far into it. But
here's a good way to look at it. It's positioning. And I know that positioning is like the residual for everything that you don't understand, or, it's positioning. But in this case, it really is. So Todd Stone, at least I think it is, Todd Stone has a chart showing the VIX futures net position, and everybody has been short, or the market has been net short volatility for the better part of the last decade, because for the most part, outside of a few blowups, we've been in a calm market. And now you could barely see it poking up, but investors are net long volatility, which means, I think, Callie, correct me if I'm wrong, that people are buying insurance in the case that something does go haywire next week.
Yeah, and that's the environment you want before an event. You want people to be braced for it and ready for it, because that leads to a relief rally after most often. So this is a good thing. We haven't heard a lot of good news around the election. I'll give you one. People are positioning for it.
Okay, last chart before I hand the baton to you. There's still a lot of money in money market funds. And I don't know I don't know that I necessarily expect money to come out of money market funds and into the stock market. In fact, let me just say definitively, I don't expect that to happen. But there hasn't been a dip, I guess is what I'm saying. And forget the money market part. That's neither here nor there. There hasn't been a dip. So Balchunas tweeted this. This is from Tom Serafagas. And they said, to buy the dip, there needs to be one. So they say the aggressive performance chasing may stem from investors' growing impatience, given there have been fewer opportunities to buy market dips in recent months. So the S&P 500 has been positive. This is what the chart shows. On 63 of the past 100 trading days, the most consistent advance since September 2007. And dating back to 2007, this is almost about as good as it gets in terms of positive days out of the last 100. So it's odd. Chart off, please. How calm the stock market is heading into an election that has a lot of people on both sides of the political aisle pretty anxious.
Yeah. Did you have this on your bingo card at the beginning of the year?
No, but this just goes to our point that not to ignore or not to turn on the TV. Like, listen, we're human, but really, Barry's been pounding this drum for forever. Don't mix politics with your portfolio.
Yeah. Yeah. And don't let it push you into making rash decisions. Actually, this is a really good handoff to the next section. So, Michael, I'm going to take it. If you don't mind. All right. So, sitting out versus staying in. I've got a little stat of my own. You guys know I'm the stat queen. So, pulled a few stats for what are your thoughts tonight. This is the first one. So, Michael, the S&P hasn't had a 1% up or down day the entire month of October, which, by the way, October is the most volatile month historically for the S&P. You see a lot of 1% up and down days.
Hold on, just to repeat. I was about to say double click, but I want to punch myself in the face for even thinking that. The fact that not only are we in an election year, not only are we in what has seasonally been the most volatile month in the calendar year, like there's no volatility. It's really unbelievable.
It's wild. So no 1% down day this month. It would be the first October. If we get to the end of the month, don't get a 1% up or down day. First October since 2017 that's happened. First October in an election year where that's happened since 1968, which I think was the Nixon election, if I remember correctly. I did pay attention in high school history, which is wild. I mean, it's so quiet, Michael. It's like eerily quiet. And I've heard from a lot of people, some clients, some friends and family, that it's almost like nervously quiet.
It's weird.
Almost like
it's weird.
what's gonna happen? What's the next shoe to drop? Maybe it's the election. Maybe it's I don't know, the October jobs report, because we do have a busy few weeks coming up.
I'm not a calm before the storm person. Like, I wouldn't be surprised at all if the market reacts violently one way or the other based on whoever wins. Like, that wouldn't surprise me either. Maybe I'm giving the market too much credit, but like we know the election's on the calendar. It's been on the calendar. We know exactly what it is. The idea that like the election is going to shock people. And listen, hopefully these are not famous last words, but wouldn't it be like sort of poetically hilarious if the market closes like unchanged on Wednesday?
Oh my God, I would love it. I would love it. It would be like, the market gods,
it'll be a mic drop for us. It'll be a mic drop for us, right?
Yeah. I wish I had election day returns that I could pull out of my brain. But chart on, John. I want to show you guys something. All right. So like I said, a lot of people have asked me about the calm October. You know, really over the past few years, the market has been so resilient. So I've gotten this from time to time. Why is the market so quiet? Everything feels like it's falling apart. Well, markets can stay quiet for a while. This chart, as you can see, is the number of months that the S&P has stretched without a 1% down day. Right now, we're at a little over a month. I think it's like 1.2 months. Couldn't tell you how many. It's like 40 trading days. But anyway, the S&P has gone as long as 5 months without a 1% down day, which is absurd. I mean, the S&P can stay quiet for a while, and I bet when that has happened, the market experts have gotten the same questions, Michael. So do you sit out? Do you stay in? I think you stay in.
What do you mean? Do you sit out or do you stay in?
Is it time to maybe take a few chips off the table? I'm not saying like sell and run for the hills, but I know you're not a calm before the storm guy, but is there harm in taking a little bit of risk off the table?
I would say it depends on what you're doing. If you are like in your 401k, never, ever touch that. If you have a trading account and you've got stocks that are up 40% for the last 12 months and you want to take some gains and just like see what happens. I mean, I don't know. It's such bad advice. I don't know. I would say, no, what am I talking about this? No.
Pushed him into a corner there.
No, well, let me ask you this. Okay, let me ask you this. What happened? Okay, so if you were to give the advice, yeah, you know what? Maybe take some chips off the table and let the dust settle. Well, what happens if the market gaps up 4%? Then what?
I know. Then you missed it. I mean, I think that's an argument for staying in. The one thing that I'll say, though, And I'll remind everybody, bull markets can last a long time and they can leave you in the dust really fast. I mean, we're talking 5.5 years on average since 1950 with average annual gains of about 20%. I mean, that's a lot. So, I think you hinted on something really interesting, Michael. Yeah, maybe it is time to rebalance on any volatility you see. Maybe it is time to maybe cut a few tech stocks and rotate them into more value-oriented stocks, more rate-sensitive stocks, especially if you're feeling a little more defensive. But I think so often people look at it as like a black and white thing.
Yeah, should I be in
and
or
it's
should I
really
be out?
not. No, it's not. There's a lot of gray there.
So if somebody wants to do that and say, hey, I've killed it in NVIDIA. I want to get into whatever, maybe a more boring sector and maybe be defensive. That's one thing. Fine. But the idea of like, I'm going to get out and see where the dust settles it's always a terrible idea because either two things happen. Let's say that you're like a little bit cautious. You're just not feeling it. The market goes down 5%. Okay. Well, are you buying back in then? Probably not. Because guess what? Market doesn't go down for no reason. Market goes down because people are selling. People are selling. People get scared. Okay. So then you start feeling yourself. Oh, okay. I'm going to wait until it goes down another 5%. Market goes down 10%. Now you buying? Fuck no. Market's down 10%. I'm like, I'm not buying now. Are you crazy? Okay. So that's one scenario where it never comes in enough, right? Where you start to talk yourself into it. You start to get scared. That's scenario number one. Scenario number two is the market goes higher and you will never buy back a stock higher than where you sold it. You just will never do it. So the selling is the easiest thing in the world. Oh, I feel good. I'm safe. Getting back in is impossible. So not impossible. But you know where I'm going. So I would never advocate that sort of strategy. That's not long-term a sustainable, successful outcome because how many times are you going to do that in your life? Right? Every time you get nervous, you're going to take some chips off the table and wait to see how your emotions deal with the volatility. This is not.
There's a chart that I've seen. It's called Everlasting Reasons to Sell. I think it's pretty.
Yes,
I think it's a good one, Michael.
That is compelling. Okay, so let's talk about the casino market. And Callie, you are the perfect person to discuss this with because you've spent your career dealing with retail investors, so you know what you're talking about. Eric Balchunas, and let me just set this up. So Josh and I were speaking with Jason Zweig, which was just what a thrill for me that was. I think listeners could probably tell, but that was really, really special for Josh and I. And we were talking about what Jason refers to as the gamification of markets. And I'm trying to be optimistic here in the sense that, like, yeah, listen, my knee-jerk reaction is like to hate this stuff. Even though I love gambling in Vegas or in your FanDuel account, whatever, like maybe not so with the market. But my optimistic take on this is that people are, for the most part, I'm painted with a very broad brush, doing it with a small portion of their portfolio. They're under no illusion that they're doing anything other than gambling. And I think that the longer you do this, the more likely you are to be like, oh, this is a waste of my time. I'm just going to read a book or try and make more money at my job or be with my friends and family or whatever. And the sooner you get this out of your system, the better off you'll be over the long run. So that's like my optimistic take. All that being said, there is some crazy, wild shit that is happening in the market. So Eric Balchunas tweeted, T-Rex's 2X MicroStrategy ETF, the ticker is MSTU, launched a mere 6 weeks ago and is already up 225% and trades $500 million in volume, which is among the top 1% in ETFs. It already has $1 billion in assets. He said, for context, the two leverage MicroStrategy ETFs are seeing as much volume as gold and GLD and IBM. Chart off, please. So MicroStrategy, for those who are not familiar, MicroStrategy is in and of itself a leveraged bet on Bitcoin. This is the microsailor company that is just taking all of its cash flow and even issuing debt to buy more Bitcoin. So MicroStrategy is a levered play on Bitcoin. In fact, I think it's up like 300% on the year. Bitcoin's up 60. So it's like it's leverage on top of leverage. And Eric makes a point. He said it's so funny. They've long had 3x, or what's it from Inglourious Bastards? I can't, well, whatever. 3x MicroStrategy, there we go, ETFs in Europe, but no one cares. No assets, no volume. It's a market for that amount of heat. There's no degens. The US, on the other hand, it's make it volatile and they will come. So yeah, Eric says it's a 4x Bitcoin ETF. Like that's what we're doing here. And people are trading the shit out of it as much as GLD. So what do we think, Callie? You've been in this business a long time, work with retail investors. What do we think? Is this terrible? Is it a mixed bag? Is this hedge funds that are trading this? Like, what's happening?
No. So I don't think it's hedge funds. And I'll start this off with, I will never judge somebody for what they do with their own money. I think you're closer to, when you say you think it's people with small accounts on the side, understanding what they're doing, I actually think you're about right there. I mean, I really don't think MicroStrategy, like a 2 times a MicroStrategy ETF, is one that my mom is playing, or that, your neighbor is playing, and, they don't have a 401k or an IRA out there. Investors are pretty sophisticated these days. I'm not saying they're like, this is a good idea for most investors investing for the long term, but I'm not shocked that people are rushing into it. I mean, I used to work at a huge retail brokerage globally, and MicroStrategy was consistently one of our top 20 most owned stocks. And by the way, our most owned asset on that platform was Bitcoin. So you can bet that a lot of the customers holding Bitcoin were also trading MicroStrategy too. I don't think it's a bad thing. I think it's just a matter of access. The finance industry will always meet customers where they are. So if there's a demand for it, yeah, finance will put it out. I wouldn't trade this myself. I would probably be a little more careful, but hey, some people have different risk tolerances. If you want to do it, go for it.
I think something that you said is easy for people to ignore, the fact that this is not the dumb money that you think about. These are, and again, we're generalizing. So they're dumbasses for sure.
We are generalizing.
Yes, we're generalizing always. But the sophistication here, like, people know what they're talking about. And I think the Reddit boards have educated a lot of people, and people know what they're doing. I think that, like, again, painting with a broad brush, but I think that the average person who's like, what are you talking about, Michael? You think these are smart people? I think you'd be surprised.
Yeah. There are a lot of technical traders who I'm sure are getting into this. And I am not a technician, but I do know when there's a lot of movement, technicals come into play. That actually was a really not a great statement.
No, but not even just technicals. Like, there's like premiums involved in MicroStrategy above and beyond like its net asset value or what
arbitrage.
Bitcoin is worth. Like people know that they're overpaying. Like, they know what's happening. They know what's on the balance sheet. They're not just like number go up. I mean, some are, of course, but I think that they know what they're doing generally.
Yeah, and the other thing I'll say is, oh my God, they're getting on a brokerage account and they're putting their money in a stock. That is incredible. Americans weren't doing that at large a few decades ago.
Yeah.
I almost boil it down to the least common denominator, Michael. I'm like, I would probably never do it, but I think it's a good thing that, people are getting on opening brokerage accounts and kind of experiencing this for themselves.
I think that's where I'm at.
Taking
like
a few steps.
The bottom line is, the more people invest, the better off they will eventually be. Even though if I can wave a magic wand and eliminate it, I would. But it's not black or white, right? Like, this is a very complicated topic that we could spend hours on. But before we bore you and do that, let's move on to the next topic. Callie, what's going on with the 10-year?
Yeah, before we bore you with MicroStrategy, let's talk about 10-year yields.
Yeah.
Isn't that hilarious?
Yeah, good segue.
So I want to show you guys something called the MOVE Index. Turn on, John. MOVE Index. All right, so we were talking about the VIX a little bit earlier. The VIX, if you remember, is a gauge of S&P 500 options prices. This is its even nerdier cousin, the MOVE Index. So the MOVE Index is the price of 1 month over-the-counter options on 2, 5, 10, and 30-year treasuries. What people call the VIX of bonds, Michael. And the MOVE Index right now is at 131, which is about the highest it's been in a year. So what's going on here? Like the VIX, you have to understand a little bit about how it works, a little bit about why institutions, this isn't really a retail tracking product, why institutions are buying protection or, options on bonds. And the answer is the 10-year yield has moved a lot over the past month. I think it's moved almost 50 basis points in October, which is a huge move. We don't see that a lot. So what's going on? To understand what's happening in the MOVE Index, you have to understand that the 10-year yield is moving. Why is the 10-year yield moving? Why do you think, Michael? I know there are a lot of theories there, but
yeah. So
what's your guess?
Ben and I were talking about this today. I think I'm going to steal from War and Pies. I think it's a combination of two things. First and foremost, well, how about this? Let me start with why I don't think it's moving. I don't think that it's a deficit. Okay. I don't think that people are all of a sudden Now, real big money. I know there are plenty of people that are worried about the deficit, but I don't think that there's enough money moving around that's worried about the deficit to send this multi-trillion-dollar market one way or the other. So I think it's moving for two reasons. Number one, and this is from Warren Pies, it's the unwind of the recession fear trade. So people were preparing for lower rates, and they were positioned for lower rates because they thought the economy was going to be softening, that the Fed was going to be aggressively cutting rates, getting back to neutral. And I think that they had to unwind that positioning, and now it's going the other way. And why is that going the other way? Well, this is baked into the pie. It's because the economy is a lot stronger than people thought a month and 2 months ago. Mm-hmm. Do I have it about right?
I think you're right. I think it's as easy as we thought a recession. We markets thought a recession was coming in July and August.
And we were wrong.
It never came. We were wrong. The economy's okay.
Yeah.
And maybe we're tipping a little too far to the other edge now. Yeah. Chart on, John. I want to show you something. Okay, so this is the chart that I've been pointing to, Michael, when people have asked me about the 10-year yield.
Oh, I love this.
Yeah, this is a chart of the Citi U.S. Economic Surprise Index, which is an index that measures actual economic data and how it comes in relative to Wall Street's expectations. That's a game that a lot of analysts like to play, judging data based on what Wall Street thought it would be. So this is the Economic Surprise Index. As you can see, it's ticked up a lot on the right side of the chart since middle of September, early October, which coincidentally is around the time that the poly-market odds for Trump have started ticking up too. I'm not saying it's correlated. I'm just saying that's probably a reason why people have been assigning the 10-year yields move to Trump election odds. Anyway, the 10-year yield has basically been correlated with the Economic Surprise Index. That makes a lot more sense to me. The 10-year yield is an economic proxy.
Yeah.
I do think it's gone a little far, though. I think 4.2 is a little hefty.
Okay. So some people would look at this chart back on, please, and dismiss it and say, well, look at the left side. There's nothing there. And all of a sudden, now listen, okay, sometimes there's noise and sometimes there's signal. And in this case, I do believe, even though I'm very sensitive to chart crimes, in this case, I do genuinely believe that the economic strength is driving yields higher. I don't think that's a stretch at all. I just think, come on, common sense, eyeballs, that's what's happening here.
Yeah, sometimes it really is just common sense and the easiest answer. But let me throw one more thing out at you. So I actually forgot to put this chart in. Guys, I had an awesome chart, forgot to put it in the doc. I'm so sorry. But the 10-year yield, if you look at break-evens, which is the difference between the 10-year yield and the 10-year TIPS yield, so basically the market's expectations for inflation, break-evens haven't moved over the past 2 weeks. So you have some people saying, oh my God, inflation is coming back. Here we go. It's the second coming of 2022. Markets aren't really reflecting that. And it's interesting because the 10-year yield is going up. Inflation expectations are staying stable. That term premium, they call it, that bucket of everything else, every other reason that the yield could move is getting really high. It's around 2% right now. So when I think about where the 10-year yield is going, I point to that 2% term premium. And, I see that coming down. For what reason, what will make it come down, I don't know. But things seem lofty right now.
I also think the fact that this rise in the 10-year has not coincided with the stock market sell-off, which every other move of this magnitude over that period of time has, tells me that the market is not concerned about the move because it's economic growth, which is supportive of fundamental strength, earnings, and all the good stuff that drives markets higher.
Yeah, and this actually ties back to what we were talking about earlier about the lack of, really movement in the stock market, just grinding higher. Expectations were way too low coming into October. It doesn't mean that the economy is doing spectacularly right now, but it's doing just well enough that people are pleased.
Well, I think the initial jobless claims was a real head fake.
Oh, yeah, it totally was a head fake. It came and it went.
Yeah.
It was probably hurricane related.
All right, good stuff. Anything else on here, Callie?
No, just watch the 10-year yield. I think this is the most interesting story right now outside of the election, which probably tells you why it's quiet in markets. Okay. But hey, I'm a nerd. I think bonds are interesting.
All right, let's talk the megas. Global equity returns are... All right, forget about the title of the chart. Just look at the chart itself. So this is from Torsten Slack, and he's showing the market cap of NVIDIA at $3.5 trillion compared to market caps of G7 countries. And outside of Japan and outside the United States, NVIDIA has a larger market cap than Canada, the UK, France, Germany, and dwarfs Italy. And now, like, these numbers just get lost. So I love context because, chart off, please. 3.5 trillion. Like, what's a trillion? Like, it's such a big number that it loses its meaning. You know what I mean? So I saw this tweet from Sam Lessin that really did a great job contextualizing what the hell we're talking about here. So he said that Meta is worth almost exactly the same as the sum of all New York City real estate. Apple is 2 times larger, and he says sometimes it's hard to feel these huge numbers without a comparison. So, I don't know that any of this is actionable, but I saw that it's like, holy shit! I don't know which one is wrong or if they're both right. I genuinely defer to markets, but wow, Nvidia is Meta's worth more than all of New York City real estate.
Yeah, it is one of those charts and those stats that just makes you kind of lose your breath a little. You're like, wow, a trillion. We're talking about $1 trillion. $1 trillion is a lot of money. Multiply that by 3.
Remember? Yeah, I know you remember when Apple first crossed $1 trillion and people were like, all right, this is going to do it. This is going to be the top. And of course, like you can't throw out market caps or anything without talking about, well, okay, how much revenue are they generating? How much cash flow? What are the margins? What are the growth? And listen, we, the market investors, we're not stupid. There's a reason why Meta is worth 1.8 trillion or whatever the number is. Like, there is a reason. And it doesn't mean that it is always right or that, this won't feel foolish with the benefit of hindsight. We don't know. But that's the point. Like, we don't know. But it is wild nonetheless to think that Apple is worth 2 times more than all of the real estate in New York City. And maybe that's right. Okay.
Yeah. One thing I want to point out on that first NVIDIA chart, John, can you throw up yeah, that's right. So this is a chart from Torsten Slok. And when Michael first sent it to me, I was like, oh, great. It's another one of those stats that's like NVIDIA is bigger than like these 50 economies combined. And it is kind of that. But what Torsten pointed out in the report, which I thought was really astute, is the fact that, I mean, NVIDIA being $3 trillion, that means that it's globally leveraged. That means that investors all around the world are invested in it. And you can kind of see that in the numbers. I mean, NVIDIA can't be that big just on American shareholders' backs, So I don't know if that's a good thing or a bad thing. I guess it shows you just how robust and, I guess, well-known our biggest companies are.
You know what I want? I want apples to apples. Show me the revenue of NVIDIA versus Canada. No, seriously.
Yeah,
like
I want to see that too.
Like NVIDIA versus Canadian companies. Is NVIDIA doing more revenue than every company in Canada? No disrespect. I don't know. But I mean, it's not out of the realm of possibility. Listen, these are the type of things, you don't say this on a podcast, right? Because you might look really stupid. I don't know if it's possible or not, but I feel like I need to, you know what? Homework for Chart Kid. We'll do that. Yeah. We'll do that for next week.
All right. Get that to Matt. Yeah.
Sticking with margins and fundamentals. Where are we going next?
All right. We're talking about margins. So chart on, John. I will never get used to saying that, by the way. Okay. So I thought this was super interesting. And Josh actually sent this to our little research group we have going on at Ritholtz.
Shout out to Adam Parker.
Yeah. Shout out to Adam Parker, one of the best on the street. So this is a chart of profit margins. I believe operating margins, gross operating margin, broken down by market cap. So the blue line, as you can see, is for the top 50 stocks, I believe, on the market. And then the green, wow. The black line that you see at the bottom, I know my colors, I promise. The black line is for stocks from 51 to 500. And what you can see here, and I'll remind you, so the story about profit margins is that they've been steadily rising since, really the beginning of 2022. They took a little bit of a dip in 2023 and are back to marching higher. The talk around that is greedflation. The economy is so strong. Companies didn't get hit at all. And that's actually not true. I mean, Adam Parker found that, that step up in profit margins really was the result of the mega caps, Mike. It wasn't a story for every stock on the market. I mean, certainly not every stock, but even for, those large cap stocks that aren't exactly the top dogs, that aren't those tech giants with huge competitive moats. We saw a little bit of damage there in 2022 and 2023.
I love this so much. Not that I needed my faith in markets restored, because I do believe, chart off please, I do believe that markets move on fundamentals. I do believe that there's a lot of dumb shit that moves markets, on any given day, obviously. But what that chart showed, and chart back on, please, look at the black line, which shows the profit margins of the S&P 500, besides for the top 50 market cap weighted companies. Margins got hit big time. Like, they really did. Look at that. It went from 45% down to, 38, whatever the number is. That's serious deterioration. And guess what? Look at a chart of RSP, right? It's the same thing. We're only just making all-time highs in RSP a couple of weeks ago as we're getting the rebound. So the businesses got hit. The stocks got hit. The businesses recovered. The stocks recovered. This is what drives markets. And we don't know where fundamentals are going, but this is the shit, right? So I don't care about who the president, just for the market. I don't care about don't tell me who wins the president. Tell me what the margins are going to be. Like, that is so much more informative for where the market is going.
Yeah. And this is the story of earnings too. I mean, if you look at corporate profits, over the past few years, we saw a little bit of a dip in 2023, but what you didn't see if you looked at the broader view is the fact that tech, really has led earnings growth over the past few years, and earnings have just now started broadening out and moving to other sectors. So we're seeing a bit of an earnings recovery right now, which is really interesting to think about. We probably, if you had to guess without looking at the numbers, you'd probably say, we're a little more late cycle and earnings would look toppy, but that's not really the case.
I think I did this years ago, just rid myself of like the market cap number in terms of, it's such a big number. Yeah, okay. We all have access to the same information. And as long as, I think what shocked me more than the market caps was the fact that the companies of this magnitude, Google, which just reported 50% top line, 37% bottom line, I never would have believed that this sort of fundamental expansion, trees don't go to the sky. Oh yeah? These trees are growing pretty tall. And I know it's not forever, but my goodness, the bar has been high for these companies for the last decade, and they just keep raising it. So great chart in terms of the market's reaction to earnings, which we are in the thick of earnings season. This is from Bank of America. We're looking at the most positive reactions to beats since the fourth quarter of 2018. And given that we're in a bull market, man, you just love to see this. So I remember talking with Josh a couple of years ago. Holy shit, it's been years, huh? That even beats were getting pounded. It was 2021. Stocks that were beating were still getting destroyed. And we know the story there. But the fact that companies that beat on both the top line and the bottom line are getting re-rated higher. Chart off, please. What else do you want to see, people? Like, this is it. This is the thing. We're doing the thing. Companies are beating. Stocks are reacting. You love to see it.
But the same is happening on the other side, Michael. Stocks are missing and they're getting punished. So what's going on?
I love to see that too. This is how the market should work. It's not index fund investors, and I'm not saying that's not maybe a piece of it. Flows matter, of course. Positioning matters, of course. It's the fundamentals. AMD. How much is AMD down in the after hours? Okay, they reported bad, whatever, and the stock is getting whacked. Good, that's the way it should be. I don't like chaos. I don't like to see anybody lose money, but I like to see that the market is tied to fundamentals. And I could hear people in the back of my mind, oh yeah, if the CAPE ratio, pre-E, blah, 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 blah. The market is doing what the market should be doing, at least as far as I'm concerned.
Yeah, and I think that this is a reflection of how low the bar is for earnings this season too. At the beginning of the season, I think the Wall Street estimate for profit growth was around 3%, which is low, by the way. If you look at estimates for the quarters after, I think it's 10+%, which, that's Wall Street for one. They always start really high and then cut. Mm-hmm. But the bar was incredibly low to the point where I think revenue growth was expected to be higher than earnings growth. You don't see that a lot. The bar's low. If companies hurdle the bar, people are happy. If the bar is lower, then companies have an easier time hurdling. And you have to remember too, Tesla went up 20%. So there's a little bit of herd mentality there too.
Yeah.
Yeah.
Callie, anything else for the audience?
Yeah, I've got a great chart to close us out on, Michael. Speaking of fundamentals, so margins. This chart, sear it in your brain. It's one of my favorite charts to show people. This is the money chart. Margins matter. Margins have lined up with market trouble in the past. The shading that you see on this chart is corrections in the S&P 500. That's a drop of 10% or more. Corrections, at least for the past 15 years, have almost perfectly lined up with drops in the profit margins. And you're looking at operating margins here. And the second thing I want to show you is the estimates for profit margins going out. Again, Wall Street does this. They like to start high and cut into the season. But estimates for profit margins are basically going straight up through 2026.
Wild.
Is that a good story? I think it's a good story.
Well, now the story's baked in and we got to get there. But one of the bear cases from one of the most prominent, let's call it bearish shops on Wall Street is GMO. And the bear case in the 2010 decade was that profit margins are the most mean reverting series in finance. Just for the simple fact that, listen, if margins are too high, competition comes in. And what they got wrong, and by the way, I would have gotten it wrong. I don't fault them for not being right on the future. The future's impossible. What I think that either they didn't understand or what they couldn't foresee, because we can't see the future, is that the dominance of tech specifically was going to keep margins high and continue to have them higher and higher and higher. And there's no precedent for this in history. So GMO, students of market history, you look, there's nothing like this. The playbook, it's a new playbook. It's a new paradigm. And so, yeah, there are limits. And I know this sounds pretty toppy, but like the point is margins are the thing. And margins have continued to go higher. And when they come in as they did, the market goes down. And when they go back up, the market goes back up. So, but now we got to meet him, right? So the good news is that markets are high, stocks, businesses are doing well. No, bad news, but the expectations are higher now. Okay, so now we put up and now, or we shut up and put up. I don't know what the phrase is.
But put up and shut up?
Yeah.
Put up and shut up?
Yeah.
Gotta put up and shut up.
Yeah, listen, phrases are tough when you're talking to a microphone. You realize how dumb the English language is. So, all right, listen, Callie, you are the best. Thank you for making this show so much fun tonight. We're going to be back next week, but not on this program. This is a programming note, so to speak. Play the music. Okay, there we go. All right, so next Tuesday, we're taking off because you are going to be voting. You're going to be voting on Tuesday, but we're going to be back. Myself, Callie, Josh, and Ben are going to be here on Wednesday for a mashup election. What are your thoughts? And we're going to talk about the results of the election through the lens of the market, of course. What is the market's reaction? Is the move moving? Are stocks higher or lower? Whatever. Callie, thank you so much for coming on.
Thank you for having me. Always a pleasure. Subscribe to Optimistic Callie. Got the best research in the business.
Without a doubt. Thank you very much for listening. Hope everybody is enjoying themselves and have a wonderful night.